Who would have thought that this came along, right, just when everybody was getting constructive from a cyclical point of view? Now we got people looking in the rearview mirror at the period post-August, calling it a Fed-induced breakout. What do we think now about global growth?
Yeah, it did come out of the blue a little bit. But if you look at it, I mean, a VIX of 49, the fear index is at 49. It was 44 in March of 2009 when the world really was coming to the end in an economic sense. So this seems to be a panic and overreaction, ready for a short-term bounce. I do think we need the Fed to send a signal with a quarter point very quickly, hopefully next week, maybe Monday. It's not the cure to the virus, but it is a signal. And
a signal.
I don't think that would hurt.
How does it help, Barry, if you can help viewers understand what a Fed cut does for the markets, the economy? What is the constructive element in an emergency cut?
Well, if you look at the 10-year break-even inflation, it's been plunging with the 10-year yield. If you look at the 5-year forward inflation swaps, they're also down. So they're not meeting their inflation mandate, and they probably do need to steer a little bit towards the easing side. Also, and I've been a critic, as you know, for a couple of years on the Fed policy, they had no business going to 2.4% last year or even staying at 1.6 now. When you look at what's called the G10 ex-US, the major countries in the West ex-US, they're at zero rates on a GDP-weighted basis. So our spread to them is so wide that it's at a level that it previously induced recessions within a year and a half. So there's all kinds of good reasons to cut, and it's a good signal.
Scott Nations, I hear the argument that this is a panic. I mean, certainly the VIX went from around 15 to 46 today pretty quickly, but we're back at October levels, even right now, which is not that far. Haven't lost all the gains for 2019. Is there an argument that this is really taking some euphoria or perhaps unnecessary exuberance off the table, but this isn't a panic at this stage?
I don't think this is a panic yet. And why do I say that? It's because in a real crash, you see discontinuous trading. That is trading that gets really sloppy. Nobody can understand what price they're likely to get. And while the numbers have been ugly, the trade has been relatively calm. You may not like the price you get, but you get the price that you expect. And while we're off more than 10%, again, there haven't been air pockets. It hasn't been discontinuous or ugly. And that's really the sign of some sort of a crash, is discontinuous trading. Now, what could cause that? If we have some sort of contraption, and every crash is husbanded by some sort of financial contraption that comes unglued, unwound, the worst possible time, and injects leverage. And what might that be now? It might be overnight repos. It might be illiquid ETFs. But when that happens, that's when we see discontinuous trading, and that's when we really see chaos.
So, Scott, so often when we talk about these drops, we talk about them as though the levels where we were trading right before them were completely rational by historic standards. I don't know that that's necessarily the case this time. So given where we are now, if we're talking about the S&P, if we do have a valuation adjustment to where it's more in line with historic levels, and we are considering a short-term hit to corporate profits because of coronavirus, what do you think is a reasonable level where the S&P would be settling out along those circumstances?
I would think between here and another 5% down would make a tremendous amount of sense. But remember that if the Fed keeps rates too low for too long, and I'm going to disagree with Barry completely, I'm going to agree with Ken Langone. The Fed is the problem here. They kept rates too low for too long, and asset prices got inflated into a bubble. It's not the first time the Fed has done this. They did this in the late 1920s. They did it in the middle of the 2000s, and we know what happened at the end of each of those decades. And this is not subjective. Look at something objective like the Taylor rule, which says that the Fed funds rate should be about 300 basis points higher. So if the Fed has been looking at the economy and can't find inflation, it's only because they've been using a 50-year-old measure that's outdated. All they had to do was look at asset prices.
Barry, I will read one line for you from RBC. Cutting now, when Fed funds is already 100 basis points below neutral, further cements the dangerous precedent already set that the only independent variable in the policy reaction function that matters is what the S&P is doing of late. Don't you think a cut is going to reinforce that view?
Yeah, a few things. One, the causality now runs from the stock market to the economy, not the other way around. That's just reality. And also, on the other speaker's point, yeah, I would like to wave a magic wand and make the trillions of dollars of debt go away, but the fact is it exists. And if we do raise rates to anything approaching Taylor rule, we're going to get a massive deflationary depression. I don't know if that would stand politically. And as far as RBC goes, if you look back to the fourth quarter 2018, the Fed only needed to touch the neutral rate to trigger a nearly 20% drop in the fourth quarter 2018 in the S&P. And I believe we had 1 month there where we were down about 2.5% on retail sales, which is the causality I referred to earlier. So, right. You know, it would be nice to take the medicine, but I don't think this is the time for experiments of, you know, after you're pregnant, it's a little late to become chaste.
So when Kudlow said, no, one thing to Barry, when Kudlow said literally 20 minutes ago that the stock market's not the economy, you don't think that's entirely true?
Well, I just look at, for example, the year-to-year S&P 500 correlation to the year-to-year consumer confidence. It's tightened up in the last decade. So, yeah, I think the wealth effect matters a lot for marginal propensity to consume by stock-holding individuals. We already have maxed out consumption and no savings in lower income quartiles. So, yeah, I think the stock market does matter.
Scott, last word?
Carl, my point would be that this may not be the time to react for the Fed, but they've had the last half of a decade to do it, and they were cutting rates at a time when we had 2% growth here in the United States, which is not great, but pretty good, and a stock market at all-time highs up 30% for the year. And Neil Kashkari kept saying on Twitter they couldn't see inflation and they weren't going to raise rates until they saw inflation. Well, Mr. Kashkari, if you couldn't see inflation, it's only because you didn't know where to look.